Welcome, everybody, to the Scale Up Show. This is your host, Ryan Staley, and I have a very special guest with me today. I have Randy Wootton. Randy is the CEO of Maxio, Navy veteran, and a tech leader. Some really cool things that Maxio has done is they've integrated a platform with a new brand, over 2,400 customers and 13 billion. That's with the B, like a Dr. Evil B, a billion in invoicing volume per year. On top of it, too, he's got 25 plus years experience of working at some of the big boys like Microsoft and Salesforce. Has done some really cool things as well on social issue side, specifically the U.S. Navy, and co-founded the platform VetForce at Salesforce to empower military veterans. Randy, I hope I got it all in. Welcome. Happy to have you on the show, man.
I think you got the highlights. Thank you for having me, Ryan. Looking forward to the conversation.
Yes. I am as well. Love your journey. Love your story. And I think it's really cool about how you transition from tech on the go-to-market side to effectively more on the CFO or financial side. So we're going to get into that as well as some other things. But first, I want everyone to have an understanding about where you are in the stage of the journey over at Maxio. So can you give us an idea on where you're at in terms of the revenue stage and journey you're at?
Right. So we're privately owned by Battery. They have a discipline or focus area around majority owned growth equity. So you can think of us as about Series D. D is in dog. We have about 240 Maxionauts around the world and about 2,200 customers. And so
Okay.
we're at scale. We haven't broken through yet, but it's part of the reason I came and joined the company in 2022 was they brought two very well-established brands, SaaS Optics and Chargify, together in 2021 and decided they were going to launch this integrated platform, and they needed a little bit of help.
Love it, man. Well, yeah, I think, obviously Series D is a big size company in terms of where you're at, problems you solve, and the customers that you have. Can you walk us through your solution in maybe 2 to 4 sentences, just so we have an understanding of the outcome it creates and who it serves?
Right. So we focus on B2B SaaS specifically. And then our personas, there's two of them. One is for founders, we offer a billing solution. So think of that as an alternative Stripe charge fee. You have a product, you want to get paid for it. We help you get a billing portal. As companies grow and mature, and we talk about our vision is to help innovators unlock their next stage of growth. As companies hit that next stage of inflection, about 30 employees, maybe $1 million in ARR, they may hire a head of finance, and they're starting to take professional money from VCs, not angels, not early stage. They need to do accrual accounting, they need RevRec and reporting, and they want to better run their business using those SaaS operating metrics. That's the other value prop. So two different value props, billing, financial operations, and we do revenue recognition and reporting as well.
Okay, love that. So let's shift gears a little bit. I think that's an awesome background about your organization and what you guys do. Can you give us like a super quick rundown on like your journey? Because I think your journey is really unique in terms of how you got to this point, especially being that you're on the go-to-market with some of the big boys. So would love to hear that. And then I want to get into some of the 7 secrets of success for SaaS CEOs that you talk about a lot and keynote on.
Sure. So I break my career into 3 stages. First stage, as you alluded to, was the military. Had a great time in the Navy, was a bombardier navigator in A6 intruders, and spent 12 years total in the Navy, 8 years doing that, which was awesome. Went to business school, transitioned out. This was in 99, 2000, when the internet, my friends had gotten into it in 1997, and I thought I was going to miss the internet. But jumped in with one of those early stage companies, always been in B2B SaaS. Initially, to your point, it was go-to-market tech. So we were doing ad tech, sales, marketing tech, and then I got into sales tech. Worked my way up at a couple of different companies. To your point, Microsoft, Salesforce, did a couple of startups. And then that would be my second phase. My third phase of the career is the C-suite. I've been a CEO since 2017 in 3 different companies. One was a public company, which is a wild ride. I also had the good fortune to be at a company that was backed by Sequoia, GGV, Lightspeed, first round, which we sold to a great company, a great CEO, a guy named Doug Winter at Seismic, which is a very big company, sales enablement. I got to be in the C-suite, but not be CEO, which was fun for a couple of years, just to watch a great CEO work their magic, but not be the guy. And then I started with Battery in backing Maxio in 2022. So it's been 2 years there. And I would say the the transition for me was after spending about 20 years in ad tech and martech. I mean, it was interesting, but I felt like I was solving the same sort of problems. And I think
Hmm.
for my own career growth, I had reached this inflection point where I thought, gosh, the patterns that I've seen in these scenarios, would it apply to a different vertical? In this case, selling to the CFO. And it's a new set of challenges, a new set of people, and it has been that and more. Be careful when you make those industry shifts, because there's lots of nuances. I would say the battery team had a lot of experience in the office of the CFO. They've been incredibly supportive and provide me lots of feedback. And then we have a lot of people who've been selling to CFOs for a while. So I've been able, I think, to make this transition over the past 2 years to really better understand the persona of CFOs versus selling to CMOs or within the CMO stack.
Okay. That makes sense. So what would you say is was the hardest transition of going from like selling to CMOs to selling to CFOs? And I know obviously you're the CEO, so you're always selling, right? But you're
Always
not
selling.
carrying a bag, right?
I think the hardest thing for me was it's ironic, right? Well, one, we're also a mid-market solution. So I think if you're selling enterprise solution, there's an established playbook where you go to Forrester, Gartner, IDC, you brief the analyst, you get in the wave or the magic quadrant, and you use that motion. You go to events, you take people out to dinner, and there's just a high touch motion in enterprise sales. And I think what you find with CMOs and marketers is they like to go out to dinner and they want to meet people. And so having a nice restaurant, a dinner at a nice restaurant, you'll get people to show up. They may ghost you afterwards, but at least you got them to show up. I think the hardest thing with CFOs is because they often tend to be introverts and they would prefer to stay at home with their models, is they don't go to dinner. And so you've got to really create a different experience. You have to bring in influencers or people that they really respect to speak and share some stories, and then you may get them to come out to dinner. The other challenge is there aren't necessarily conferences that CFOs go to. They may go to some, but like if you go to SaaSter, great conference for early stage founders, but not a lot of CFOs are going there. So it's a different network. What you find is CFOs rely on relationships and references for when they're making purchase decisions. So CMOs would do that as well, but it's much more so in the CFOs. And so I keep trying to figure out how to crack into the CFO mafia. Like, where do you go to find the influencers that other CFOs are reading or listening to or reaching out to for recommendations? So it's a different go-to-market motion in that way. And then I think COVID, like everyone talks about, just screwed everything up in terms of what it means to do field sales versus more of a transactional web touch type sale.
Yeah, I think, so it's interesting you say that, because we used to sell to CFOs. They were part of it. And like, we had the most success, and we didn't like totally solve it, but by going to like vertical CFO related associations and events, and then attacking the board members, getting alignment with them, and then using their influence, because they don't get to the board level of those associations or groups unless they're well respected. So if you get one of them, then that's like a landslide effect that helps out a lot. You know what I mean?
Yeah, well, I'm gonna have to follow up after this podcast, get more insight in terms of what you did there. We've done things like we thought there would be an interesting play with the AI CPA, which is the American something of CPAs. I think it's 50,000 CPAs, 500,000 CPA firms, and 500,000 people who are CPAs. But what we found was our solution, which focuses on revenue recognition, is really a problem unique to B2B SaaS. So then you're not applicable as a horizontal solution to all CPAs. You're focused on a subset, those that are offering not just tax and audit, but instead are offering what they call client advisory services, but it's for a very specific vertical, which is B2B SaaS. So we've winnowed it down, and we're targeting that group of partners to help us get into companies either for referrals, or some of these firms are doing business process outsourcing where they take on the services, kind of like a CPA. So early stage companies, you don't hire a finance person out of the gate. You hire your uncle to do your books. When you start to get to the next stage of, oh my God, I can't just manage it through QuickBooks and my bank account, you get a CPA. And then you might, if you think about it, is get a CPA who offers these strategic services. So I think it's been an interesting play for us to try to go find CFOs that care about, or finance professionals that care about what we do.
Yeah. It's definitely very niche. So
Yeah.
there's some nuances. I can give you some ideas after like kind of what we
Yeah. Great.
talked
Yeah.
about.
Done.
Um, so outside of that, let's talk about, one of the things that you discuss a lot, which is the 7 secrets of success for SaaS CEOs, right? So would love to hear what those are, because as you know, they're multiplying like the cicadas in the Chicagoland area right now with all the cheap SaaS products that are being created. So would love to hear what your thoughts are on that, and effectively just your thoughts, your methodology, your frameworks, all those ideas.
Great. Well, happy to share. What I'm finding is none of the stuff that I'm advocating for is actually original. Like I just did a podcast with a guy that does the CFO bookshelf, and we decided to reread Peter Drucker's The Effective Executive that came out in like 1965. And everything he recommended is part of my 7 secrets that I didn't know about. But it was wonderful going back, and so all of those great thinkers have influenced what I think are these 7 components, which I'll walk through really quickly. Number one is, as CEO, you need to return shareholder value, and I think that may be so meaning you're driving overall results. If your company isn't thriving, you're falling behind. And I think that's especially true for private backed companies when you're playing with other people's money. And I do think early stage founders slash CEOs, when they still control the vote and it's their baby, sometimes they can end up in a contentious relationship with investors. And I think that the number one thing is, especially if you're coming in as a scale up CEO, or what I describe myself as a professional CEO, is I am there to deliver shareholder value. That's primarily driven by delivering the results. Okay, so that's
Mhm.
number one, overall results. Number two is establishing a winning strategy. So everyone knows what business you're in and what business you're not in. I think early stage companies in general, they're trying to get customers to pay, establish product market fit. They may have lots of different customers that want them to be different types of companies, and you just got to be super clear about, this is the problem we're solving, this is the ICP we're going after, this is the value prop we have, and this is how we're carving out a specific part of the market to try to go win. Number three is around shaping values and standards that will guide your company over time. I've seen this play out well and poorly at companies I've worked at, where it's felt like the values have been a Dilbert exercise, where you go through and you come up with good sounding values, you put them on a poster on the wall, and everyone points to them. But I think at this stage in my career, one of the things that I really like doing is working with people to create a company that people are proud of. And that is about articulating a set of values that people can believe in, that you reinforce regularly, and that and we're not curing cancer. So people working are choosing every day to get up early, stay late, to work hard, and having a sense of being with people you like, which you can talk a little bit about. The company Atlanta is based in Atlanta. Excuse me, the company I'm working with is based in Atlanta, and that has a unique component to it. Is something that I'm much more interested in. So number four is building an effective executive team. So Lincani writes about this in the 5 dysfunctions of a team. That there's a first team, and I think one of the things you learn as a CEO is how to build that first team, how to have executives move from functional expertise to rowing in the same boat. Boys in the Boat, the movie that just came out, that great book. But how do you get the executives to think first team before function? And you need their participation, engagement on the top problems. And I was just talking to one of my executives today, and he's like, Randy, my comp plan is tied to these things, but I can't really control it. And I was like, no. You're part of the executive team. You sitting in our meetings and sitting in our offsites, you're called forth to be there. And if you don't think we're doing the right thing in terms of how to optimize the business, and which will ultimately lead to the payouts, then speak up. But it's a very different relationship when you're building that executive team. The fifth thing is managing your board and investors and setting the right kind of expectations. So I was mentioning, I'm someone who's worked, well, really as a public company, that's very different, but in private company, both VC and PE, understanding when investors came into a deal, how much money they have in the deal, what their time horizon is, and what their exit expectations are, and how are you going to get there? Is it going to be organic growth, or is it going to be inorganic growth? Over what period of time? Really important. We can get into a couple of stories about sitting around at the table and saying, okay, what's the number you're going to sell at? And having wide disparity, and that creating a lot of tension until we got alignment around setting expectations. That leads to the 6th point, which is about allocating capital. to balance the yield today with the investments in tomorrow. So one of the old frameworks I pull out all the time is the McKinsey Horizon model, where you have Horizon 1, Horizon 2, Horizon 3. You can't just focus on Horizon 1. We can chat more about this if you're interested, but you have to be deliberate and intentional, especially as you hit this inflection point around Series C, in investing time, money, and talent in the Horizon 2 and Horizon 3, the next act. And it's hard because you've got all this stuff you got to be doing just today. And so managing that capital investment thesis and portfolio. And then the seventh one, I call it investing in your tribe. And one of the things when I became CEO the first time was I wanted a mentor, someone who had been in the same context I had been leading a turnaround of a public company. I wanted a coach who was going to be someone who helped me become more effective interpersonally, especially with dealing with a public company board, which I had no experience. The third thing I asked for was a peer group. So CEO job is a lonely job. Everyone thinks you're doing it wrong. So joining a group like EO or YPO or Alliance of Software Executives, or I'm currently a member of Vistage, is very powerful to have people who are smart, are sitting in the seat, making the same sort of decisions you are, who can give you reactions to ideas, thoughts, problems, but they're not your investors. And then the fourth group, I call it the personal advisory board. So this is just friends, family, people who know you, love you, who only have your best intention at heart, who've known the type of person you've been, and you've told them all your hopes and dreams, and who can really help you navigate when you're making those career transitions and just call your BS, basically. And so I think that is probably one of the most important things as a CEO in terms of the long nights and the long weeks of, are you doing the right thing? Are you doing the right things? Are you focusing the right amount of energy on the hardest problems? That network, investing in your tribe, will help, at least me, has helped me feel like I'm making traction.
Okay. Love all of those, right? There's a few that I want to dig into because they're talked about less, right? Or that I don't hear it. So I think I love what you said about managing the board and understanding time horizons and exit expectations and things like that. In light of that, when you look at investors, this is just a curiosity question, which I have every now and then, but like, what do you find easier to work for, PE investors or VC investors?
Well, I've only done one of each. I think they're good at different stages and for different reasons. What I would say, the PE model is it's a smaller board. So I have a general partner, a woman named Chelsea Stoner, wicked smart, been in the space forever, her principal, and then they have kind of an independent observer or independent board member. He's not an observer. He's on their, I guess he's on their payroll. But so there's only 4 of us on the board, and they invested at the X, they expect Y. So the incentives are completely aligned. I also think that with PE, in this case, it's not a full PE firm, but they're very clear about they want to be in for 3 to 5 years. They will go long if it makes sense. They have a bunch of capital, so you don't have to go out and do an outside raise. So they'll fund it themselves if we need to go buy another company. So some of those dynamics, which I'll talk about in a second on the VC board, aren't there. The other thing I think you get clear on is they put a bunch of money in. They need a 3 to 5x return. They want to see that, how does that look in terms of you growing the business at this size, at this growth rate? And the other thing on the PE side is EBITDA. So I never talked about EBITDA when I was at a private company. PE, we talk about EBITDA a lot, and they think about transactions in terms multiples of EBITDA, which again is different than you find on the VC side, or at least my experience. At the VC side, you struggle with the fact that you have, especially I joined Percolate when they were Series C. You have all these different investors at different stages that have come in at different values, and they have a different amount of money, and so their number is different. And that's one of those examples I was talking about when in Percolate we were selling, was having the conversation with those investors, all with different incentives, payout scenarios, and saying, okay, what does the number have to be? And the person who was in last was like, oh, the number needs to be this. The person that had been in first was like, nah, I don't know, I'd be good with that. And unless you're absolutely crushing it and everyone's gonna make a whole bunch of money, like there is everyone starts to revert to, it's like Maslow hierarchy of need. They're all nice until it becomes, okay, how are we going to carve up the pie? And then they turn into, draconian, self-optimizers. And that makes it really hard. I think the other thing you find with VCs is They tend to be on a lot more boards. So if you have the good partner, they're on 8 to 10 boards. Sometimes it feels like, and you're only meeting once a quarter. Sometimes it feels like you show up a quarter and you're just like, hey, remember me? I'm Randy, and this is Percolate. And I think part of that comes from, for them to make their money, they need 1 or 2 of their investments to hit it. The rest of the whatever out of 20, 2 out of 20 hit it, 1 out of 10 hit it. The other ones they've parsed into A, B, and C. And the A companies are the ones they think might be the ones that they make their fund on. The Bs are ones that, well, they'll pay a little bit of attention to, but it's the Cs where they just write them off. And so if you're in the B zone, you're always trying to become an A, get back up to that hyper growth, but you're always worried about being in the C where you're just like, whatever, just get me my return back. I just want my money back. I just don't want a zero. And so I do think that felt a little bit different than at Battery, where I've got one partner I talk to every week, every other week. They know they have very detailed feedback in terms of operations. I think you also have at PE firms, and Battery is one where you have operating partners who come with a lot of background and experience. So I have a go-to-market executive who sits with me, and we talk about all the things we could be doing to optimize our demand gen. On the VC side, you'll have often an HR partner who can help you recruit your staff, but they don't have that same operating partner model. So you have investors who can help you when you're trying to sell the company or raise money, and they provide extraordinary advice and connections, but they're not necessarily operators. And so they can pattern match across their portfolio, but they can't say, I was in this situation, here's what I did, here's 3 things to think about, which is what I think in a PE context where they have great operating partners can be a real value add.
Love that, man. Very hyper detailed breakdown. So I've worked for a PE backed company before, actually worked for a publicly traded company that acquired a small independent, right? But worked for PE, and yeah, EBITDA was all the rage, right? And the 3 to 5 year time horizon is really interesting because year 1 is completely different than going into year 5 with what happens and staff architecture and everything like that, and what's right. Spent. So definitely changes the look of the organization. So that looks as sweet as it can on the exit sides. All right, so let's talk about the next note, number 6, the capital and the McKinsey Horizon model.
Yeah,
walk us through that, because that's obviously, and the one we didn't even cover is bootstrapped, right? Right. There's the bootstrap, VC, PE, right? And then, but how do you kind of look at it from, and we don't have to get super deep because I want to cover a couple other things on your go-to-market experience. And I like your board breakdown as well. I thought that was fantastic. So just real quick, like, how do you kind of look at the Horizon model when you're allocating funds from now and in the future?
Well, and everyone can find this online, right? It's the McKinsey model. And so Horizon 1 is what is the set of things that are going to give you revenue this year. Horizon 2 is what's the set of things that are going to lead to revenue in, call it 18 to 24 months. And then Horizon 3 are those that are going to change the game, change the company, and it's going to lead to revenue in 3 years out. And so you can't hold them to the same standards. Like a Horizon 3 bet isn't generating revenue. What you're trying to do is get a proof of concept. You're trying to get in front of customers. You're maybe get a lighthouse customer win, get some references, and you're probably going to do 3 things, and one of them is going to hit. So it's a small team, skunk works, that is moving much faster, but it does need to demonstrate traction. So the example at Maxio, we when I first showed up, we were exploring payments as an option, and who would we work with as a partner? How would we bring that thing to the market? Would we build it ourselves? We created a small team of folks to figure out the business case, create the ROI. Like, hey, this is how much we need to invest. This is what we expect is going to happen over the next 3 years. So there was a net present value for that, and we said, okay, we can afford this many engineers. So that was year 1. Year 2, we came back. Now it starts to dial into more of a Horizon 2 type payout. Still work to be done, tuning the product, getting customers up and running, driving volume across the system, but it's up and running, and we're attaching it to deals. So we carved out 10% of our engineering staff, product and engineering staff, to focus on just that product. And so it's not a separate business unit, but effectively it's ring-fence resources. So those resources can't be deployed to other initiatives like closing out the main roadmap. And that leads to tension because people are like, oh, no, but I really need another Python engineer. Like, well, can you afford it within the business model for the core? It can't be just subsidized by the business model, the payments business. So I think having, like Chelsea would call it, a layer cake, where you have your core business, that business model has to work. You're making this much money on your customers, your gross retention, your upsell opportunity, and you've invested this many dollars. And then you layer on the next layer. And for us, that's payments. And then you layer on the next layer and the next layer. And so all of these components are contributing to your overarching growth and your ARR and your retention. But being able to disaggregate them into components is important to be able to look at the unit cost economics. What are you actually making versus investing?
Yeah, I love that too. All right, you're doing well so far. You're giving thumbs up for me. And the last but not least, right? And then I'm going to shift a little bit on some of your go-to-market experiences. I love the breakdown of kind of having, the mentor, the coach, your peer group, and then your personal advisory board. So how did you? First of all, let's talk about the mentor, because a lot of people struggle with that, the mentor and or coach. Was that one person or was that multiple people?
No, I think they're different. And then there's probably at large companies a third person called a sponsor, which we can get into, which I thought was critical at both Microsoft and at Salesforce. A mentor is someone who, in my definition, is someone who's been there, done that. So I had, for example, a gentleman named Tony Zingali, who was a multiple-time public company CEO who's led transition turnarounds, and we contracted with him. And so he would help me. We'd meet monthly. We'd talk about where the business was, what was happening, all the things I was working on. And he'd say, hey, Randy, here's 3 things to think about. And it was really, really helpful. And I think also turnarounds are hard. And so having someone who's been there, done that, and it's like, no, you're still going down the curve. It'll turn, but you were still in this trough, was really, really helpful. And I've used mentors at other companies as well. So Percolate was a Series C private backed company. Actually, Tony Zingali was on the board as an independent observer. And so he was both board member and mentor for me at Percolate as well, which was an interesting connection. Part of the reason I got the job probably too. Executive coach, I used a guy named John Baird, who had coached some of the top executives at at Apple. And he's like, I think of these coaches as people who come through like the HR function, people who focus on leadership capability development, interpersonal effectiveness. And he would come to some of the board meetings with me, and he wasn't there to rate me on how I was presenting the business in terms of the numbers. He was there to rate me and give me feedback on how I was presenting the business in terms of communicating clearly to the board and engaging with the board productively in the conversation, and then getting follow-up from the board in terms of how they thought I was doing. And that was incredibly valuable. I totally plagued by imposter syndrome, first time CEO, being public company CEO with these super successful board members, and having someone who could be a buffer, help me understand how I was showing up, where I could be better, was great. And I continued on with different coaches that are mostly on that interpersonal effectiveness to make me better at communicating.
Okay. I think that's a good delineation between the two. I guess, like, what would you recommend? And I know you work with clients in this space too, so you probably see it for folks that are early stage, right? They're at that founder. They're still establishing product market fit. Obviously, what you're talking about, I imagine there's a pretty big price tag associated with those two, the caliber of those people that you mentioned right there. What would you mention for some of the earlier stage folks that are listening?
So I'm a huge fan of what's called EO. It's Entrepreneurs Organization. The people that I know have gone through that have loved it. It's focused on very early stage companies. It's a little bit of business, a little bit of personal. People join these cohorts and are in them for their entire professional career. There's another one, which is YPO, Young Presidents Organization. And I think you have to be under 47 and your business has to be greater than $1 million. So targeting a slightly different segment. You find people often will graduate from EO to YPO because you're just dealing with a different set of problems. I don't know how much that costs, but I was too old, so I couldn't join either of those, and I wasn't the founder. So they were like, "We don't have time for you." So I had to find another option, which I'll give you a couple of. One is Alliances of CEOs. It's if you're in the Bay Area, it's run by a great guy. I'm flaking on his name right now. But it's the same sort of model. All of these are, you have a peer group, you get together on a monthly basis, you process issues, and you get feedback. The one that I joined recently is called Vistage, and Vistage targeted probably at a little bit bigger company than the bootstrap. It's order of magnitude $20,000 ish or more a year. So it's not as expensive as some of the other options, but it's maybe be a little bit more expensive than the EO or the YPO, which relies on a lot of the volunteers to drive the programming. If people are interested in EO, reach out. The new CEO of EO is a friend of mine, was on a board with me. Awesome guy. I think that organization is just going to continue to expand and be extraordinary. So I recommend those. But I think you can also, I mean, this is where like those incubators, Pioneer Square Labs, I think about in Seattle, which is a place where they bring entrepreneurs together and they incubate ideas and launch them. I think you can find network. It's maybe the point is find people that you can learn from. And that could be an investor, an early stage investor. Some of the folks, I think like T.A. McCann at Pioneer Square Labs is one of these dudes that just sits on a bunch of boards and he loves working with early stage companies. So there are people out there who've been successful, who are willing and ready to pay back. It just got to make the ask. And getting introduced always helps through the network versus just a cold outreach on LinkedIn. But I think anyone who's truly appreciative of what's happened in their life will also recognize how much luck has played and connections, and will be willing to give back to other folks. I can't mentor 100 people, but certainly always willing to spend 15 minutes with someone, chat about where they are, what they're wrestling on, put them in touch with other people. But I think what you find is early stage founders are consumed with their vision and their passion for whatever problem they're trying to solve, and they may not make space for this type of relationship. And I think it's super value and pays 10x the investment if you're able to cultivate it over time.
Yeah, totally agree, man. Totally agree. There's just, so much head trash that people have going through that process as well. So it helps with that. And then, everybody has blind spots, no matter who you are, right? So,
right.
And how good you are. Everybody's got a blind spot. So I think that's really good advice, and appreciate you drilling down on that. One last question, and then we're going to have to wrap things up. So you spent a lot of time in the go-to-market space. Then you shifted to, more catering to CFOs. We talked about the differences in that. Where do you see, because we have a lot of go-to-market leaders that listen, but also CEOs in that space, where do you see the future of go-to-market tech heading, specifically as it relates to, obviously, I don't want to say the invasion of AI, but the infiltration of AI and different tools and language models into basically every single tool, process, and piece that people have going on right now?
Wow, just for a little bit of context, the first company I was CEO of was a public company. It was called Rocket Fuel, and it was a first-gen AI company that did programmatic buying in the marketing space. So I've seen this play out in terms of what AI how it can transform an industry and a function. In that case, it was media planners and buyers. One of the things we argued for at the time was not to think about it as artificial intelligence, but to think about it as augmented intelligence. It was making you better at your job. What I think is different now, many things, but one is everybody has access to the power of the AI. You don't need 30 data scientists on staff to make sense of and build the models. The other thing is, I think next year, maybe not this year, but next year, when people are doing their fiscal year 25 planning, if they're backed by VC or PE, there's going to be an AI assumption in terms of efficiency. And I've seen it argued by some folks up to 30% cost savings because people are using AI, that they will expect you to build into your plan. So what I tell everybody is, if you're not playing with it now, this is your one get out of jail free card year, where your salespeople, your marketing people, your CS people all need to be playing with AI and figuring out how to do their jobs more efficiently and effectively, how they improve their customer success, service, et cetera. But next year, I expect every board is going to come in and say, show me how you're scaling and getting leverage from AI, because it's just assume that you're doing it.
Yeah. Love that. Yeah. It's funny because I see a lot of the PE backed companies that I'm working with have already an urgency model around that. Like, they're already asking, like, how have you operationalized AI in your business right now? And so I think what you're saying is smart. There is going to be that assumption next year of like, hey, so all right, we'll just 30% due to AI, like, go. You know what I mean?
Yeah. And I think there are three ways that people are talking about using AI in the private sector right now. One is you're taking advantage of the models that are commercially available. You're using ChatGPT to write your blog posts. I used to use ghostwriters. Now I just use ChatGPT. Number two is you're using some sort of internal AI to consolidate all the information and data that you can dump into a large language model to make you more efficient. So we have an AI, we call it the Maxio knot, which answers questions submitted via Slack by anybody by referencing our Zendesk files, our Notion files, and all these other files. So there's no one in the company that knows as much as Maxio knot right now. And it's helping us create faster response, better response, and over time we'll turn that into a front-facing customer success interface that anyone could access at any point. Those are pretty standard. The third piece, which I think boards are leaning in on, is are you a system of record? Are you really a system of record? Do you have differentiated data that you can aggregate and then put an intelligence layer on top of it? You can have either unstructured or structured data with machine learning, some sort of AI, large language model that you're feeding with this data that's then able to make your product better. So companies that build like ours that grew up as workflow automation don't necessarily have the data structure in place to be able to take advantage of the intelligence engine. I don't care. All these people who say they're AI, it's not true. They put AI after their name now. The real PE firms that do the due diligence on the technical side are going to be able to get in and find out what your database is, what your data structure is, what your data strategy is. And then they'll be able to ascertain whether or not is your tool, is your offering one that can benefit from the AI wave. And that was one of the reasons I came to Maxio, was because we are the system of record for 2,200 customers. We do have $13 billion of billing and invoicing data going across the platform. It's real data. And if we can layer in AI, we can start to help inform benchmarks. We can start to help inform how customers run their business and have it set up as an intelligence engine versus just workflow automation.
You nailed it, man. I love the three examples at the end. I wasn't even expecting that. That was like a little bit of a bonus. So fortunately, we are up on time. Like we talked about maybe we will cut this into 2 episodes. I was going to pause it, but you were on a roll, man. So I didn't want to interrupt. So this is one of the definite longer episodes of Singles. So we might have to do that. So Randy, where can people find you? Where can they find more about you and Maxio? And then we'll wrap things up.
Sure. Well, obviously, find me on LinkedIn because that's where I'm writing and posting, and love to engage and answer questions on that forum. Happy to take calls or outreaches at randy.wootton. It's WOOTTON at maxio.com. And as I mentioned earlier, always happy to spend 15, 20 minutes with someone if it's helpful to provide some quick feedback or answer a question for early stage startup folks. That's it. So find me on the conference circuit. I'm running around doing talks and love to meet people and have a beer.
Awesome. Well, I love having you on, Randy. This is great. And thank you for joining us. We will see you on the next episode.